Welcome to our first market update for 2017. I'm joined by Casey Lowe, consultant at Frontier Advisors. Hi, Casey. Now, a new American president. Maybe let's start with the US. And what are the latest developments from the Federal Reserve in December?
So they decided to end the year with a big bang. It's been 12 months since they raised interest rates, and they hiked it by 25 basis points in December. So the US interest rate is now between 0.5 to 0.75%. The reasoning behind why they've increased interest rates is because they see the economy as going quite well. US unemployment rate's at 4.7%. Wage growth is finally accelerating again after being very low for several years. So positive things coming out of the US. Looking forward though, in terms of what the market's expecting on US interest rates, they're expecting two interest rate hikes over 2017, while the US Federal Reserve themselves are expecting three rate hikes. So to end 2017 about 1.5%. But broadly speaking, interest rates appears to be finally rising again in the US after being at near zero levels for almost a decade.
So things are looking good. Seems like a good time to change president.
Yes.
As we start out the year, let's have a look back at 2016. What was some of the key things that we should focus on there?
Sure, so maybe I'll start with equities and talk a bit about bonds. For equities, despite all the doom and gloom over the year, equities ended the year higher. There were a few bumps along the way. The key ones were, in January, you had the growth scare about China. In June, you had the Brexit referendum vote, and then, of course, in November, you had the US presidential election. So in terms of how the market has treated the US election, it seems to be quite positive on Donald Trump's pro-growth policies. But in terms of his protectionist stance, that has been quite unfavorable for emerging market equities. On the bond side of things, after bond yields have been declining for a while now, it seems to have reached a historical low last year, and mid last year it has started to increase again. So when bond yields increase, bond prices fall. And in terms of what's driving this increase in bond yields, it seems to be improvement in growth expectations and also an increase in inflation expectations.
Okay, so that's looking back. How about looking forward? What's in store for 2017?
So China is still on our radar. We track several things on China, but I think the immediate risk is the devaluation of the Chinese currency, the renminbi. So far, the Chinese government seems to have it under control. They've used vast amount of their foreign currency reserve to back up the currency. They've also tightened capital controls in the country to stop money from flowing out. But whether this is a sustainable thing or not, it remains a question. So watch this space.
Sure. All right. Thanks, KC, and thanks for joining us for this market update.